From Jamaica to the world, it's just love. It's just love. Why must it be the very everyone.
It's a bit haunting, the end of that one, isn't it? Hello, welcome back to session 3 of day 1. Did you enjoy your lunch? Fabulous, because I haven't even got outside yet to enjoy my lunch, but I will live vicariously through all of you. Now, we're going to start this half of the day, continuing on the journey of accumulating our wealth of knowledge in the global energy transition space. And joining us all the way from his home in beautiful Kazakhstan, which I'm told by a couple of geomates is actually geographically quite similar to where I come from in Western Australia. So it will be interesting to see, I suppose, if it becomes an emerging destination for investing, and one you might like to talk to this fellow up here a little bit more about after he's done his presentation again. So I'll introduce him to you. His name is Mike Beer. Now, in a former life, what do you think Mike was? He was an engineer. I've got the words here, chartered, and as soon as I see the word chartered, I think chartered accountant, but he's a chartered mining engineer, and he spent the last 30 to 45 years, I'm not sure which one of those I should say, being involved in many, many projects. It's probably easier to say what he wasn't than what he has been, but he's been all over the world. And that stands him in very good stead in his capacity of General Director and Corporate Consultant for SRK. So today what he's going to do is go through the rare earth elements, opportunity or risk, how to make money, and how to identify those projects that you might like to avoid. Would you please make him welcome?
Thank you, Chrissy, and good afternoon, everyone. And I don't think I need to give any further introduction other than I think that Kazakhstan is really God's country, and you should pay it a visit. Today I'm going to talk about rare earth elements, and I've got a few slides to take you through some things you might want to consider when you're looking at those projects. And I think one of the things about rare earth elements is that most people just don't know what they are. And I don't think it's something to be ashamed about. They're very obscure. They have quite obscure applications in the main. And there's 17 of them. And they're sort of classified into heavy and light. And they're relatively abundant in the world. But in terms of economic quantities, then that's another question. There's a lot smaller subset of those, although they might occur in the Earth's crust, where we can actually recover them is much less widespread. In terms of applications, there's two main sort of categories they fall into. And that's using them as a metal that goes into various applications, or using them as an oxidized state, or as a mineral as opposed to a metal, a compound, as it were. So I'm not going to go through all of those, but there's a very wide range of uses of them. And the ones that you'll have heard of recently are how they relate to energy transition, and particularly the metals used in magnets. There's been a lot of headlines about recently, and we'll touch that a bit later on. Now, if we just look at the distribution of these rare earth deposits, you'll see that they're quite well spread around the world. And, you know, in all the sort of typical places where you find a lot of mining, the big mining jurisdictions, Southern Africa, Australia, North America. The notable gaps are, of course, Europe, and that's mainly NIMBYism. Nobody in Europe wants any mines these days. And Russia and Central Asia, there's not much, but obviously there's a big geographical concentration there in China, which is something that people have been talking about quite a lot. Now, if we look at the reserves and production, I don't think this is big news to anyone, is that, you know, there it is, China dominates everything. And in one of the speeches, or in the session before lunch, there was one of the speakers was talking about how China dominates the processing and supply of these into battery products. Well, actually, they have the majority of the reserves as well, and the production. So it really is to diversify supplies beyond China is going to take a massive effort, because as he noted very accurately, that they've had a real head start and have been looking at this for a long time. It's not a new strategy for them, and the rest of the world is suddenly realizing they're having to play some catch up. Now, if we look at geology, these deposits fall into four main deposit types. We've got the carbonatites, we've got mineral sands, where it tends to be a byproduct in those concentrates. We have iron absorption clay deposits, of which there's one in Kazakhstan that I'll touch on a bit later, some details of that. And then the fourth category is the alkaline rocks. And we see that the higher grade ones tend to be the carbonatites, as we'll see on the next slide when we have a look at the size and grade. There we go. Yes, so this shows a variety of rare earth deposits, and you see along the top there, they're separated into the carbonatites, the alkaline, the iron absorptions, and others. And you'll see that the alkaline deposits tend to be quite large, but low grade. All the crosses at the bottom there are quite low. And the carbonatites are a higher grade, but more variable in size. So there is a spread of the four main types in terms of what people are evaluating. So they're all quite different. But something I'll mention about the metallurgy is that they do have process routes, but that can be quite complicated. But something to note about this graph is, if you look at the right-hand side of it, there's a percentage scale of the rare earth oxides in there. And you'll see, actually, when you look at many of the projects that are being promoted out there, many of the grades are quoted in parts per million, which is grams per ton. Now, 1,000 parts per million is 0.1%. So if you look on the right-hand side of that graph, you can see that there's quite a lot of low-grade projects out there. And I'll show you on the next slide one of these recent players that's looking at a project in Kazakhstan and what their grades are and how it compares to that. So it is a very difficult thing to evaluate, and that's really the theme of my talk, is that people lump them together as total rare earth oxides, but actually that can be any number of those 17 elements that we talked about. And in terms of value and economic value, the percentage recovery that you can actually achieve and the cost of doing that are the critical drivers. So it's not just a question of grade, it's about how much it's going to cost you to get it out and how much you can get out of that particular metal. Now, if we look at cutoff grades, which obviously has quite an impact. Oh, go back, sorry. Yeah. If we talk about cutoff grades, on this slide, there's an extract on the right there that came from a press release from this company called East Star Resources. They're listed in London, and this is an extract for one of their press releases recently. And they quote all of these intercepts, and it's a historical rare earths mine in Kazakhstan that they're evaluating. And they've got some very nice hits there, and they've confirmed a lot of the historical results there. And that's a shallow deposit, and it's in this iron absorption clay. So it's within sort of 30, 40 meters from surface. And it's a very particular style of deposit, and it's mainly yttrium. So those grades, though, when he talks about 2,000 parts per million, that's only 0.2%. So it's still relatively low when we compare to that graph on the previous slide. So when we look at cutoff grades, typically for iron absorption clays, the cutoff grade could be very low, about 0.1%. So these numbers that we see from East Star are in the right ballpark. They're what we'd expect. But for the hard rock ores, they tend to need a much higher grade to be sustainable. And that's typically 1 to 5% total rare earth oxides in our experience. And I think that one of the things to consider from the resource geologists or from the project perspective with this is that if you've got a rare earth occurrence that has not been mined in the past or have any production history, then it's very challenging to put a value on the cutoff grade, on the recovery, because you simply don't know how much it's going to cost you to recover and the percent recovery that you'll get. So those are massive variables. So if you're selecting a cutoff grade, you might define a resource, and then when you come to do the metallurgical test work, that there's not enough metal there to pay all the bills. So I think that's a very important consideration when looking at these projects is what is the basis of your cutoff grade? Because if you're doing a maiden mineral resource on a project that hasn't been mined, you might be doing that project and there's no metallurgical test work available or very limited. So putting the right number on your maiden resource estimate is going to be a challenge. I guess you would just have to make an informed guess at an early stage. And as we'll see later, you'd want to do some metallurgical test work very promptly in your timeline of project evaluation. So if we just look at the metallurgy now, let's click up. There we go. And as I mentioned, metallurgy is key. It's probably one of the biggest considerations when you're looking at these kinds of projects. And we can't recover all of the metal. We know that, and it's going to be a challenge. Some of these ores are refractory that you won't be able to recover them. It's going to require multiple stages, as we'll see on the next slide. And there's a variety of products depending on application. So you might wish to recover a metal, or you might wish to recover some other mineral compound or crystal that might go into some particular application. So going a bit deeper, I think we have to consider this really as more of a chemical engineering exercise rather than commodity and traditional kind of mining. There's nothing standard about this. It's not like bottle rolls that we might have for a gold project. You do a few bottle rolls, you confirm cyanide recovery, and you know you're probably not going to have a lot more problems. Same with the base metal, you do some flotations, and you can have a pretty good idea that you've got a viable process route. But with the rare earth elements, it's much, much more challenging. So in this example here about treating a hard rock rare earth ore, that typically you'd go through all of these stages, the crushing, the grinding, and you might have to do some roasting of it. There'll be some leaching, you remove impurities, and you get to a solution where you have to do solvent extraction. And that solvent extraction stage, in theory, some metallurgists told me that if you wanted to recover all 17 from a given solution, you might need several hundred up to 1,000 stages of solvent extraction, which I find hard to believe personally. But it was illustrating the point that these rare earth elements have very similar properties to each other, and it means they're very difficult to separate from each other. You might be able to dissolve them all, but how easily can you take them out is the key question we have to answer when we're doing something like a due diligence or just developing a project. So a good example of a MET test work sort of program is if I go back to the E-Star press release, and this is a direct extract from it and what they're planning to do. They've got these good assays confirming the historical drilling results for that project. And now they're planning MET test work. And just look at it. I mentioned about what bottle rolls were like and how relatively easy bottle rolls or flotation is. Look at this, all these chemicals that I can't even say the name of some of them. And you know, what's an acetic acid leach? Is that vinegar or something? I don't know, but it's very obscure, but it's very complicated. So this is, remember, this is a deposit where there's only 3 real elements of economic interest, and the main one, yttrium. So they're still looking at 5-stage sequential leaches just at the scoping level. So you can see the levels of complexity that we're dealing with here. It is not a slam dunk. It's very difficult to make informed decisions on limited information with a rare earths project. Now, if you think that's bad news, there's more. Radioactivity. Typically, you get radionuclides occurring in some of these rare earth elements. And when you beneficiate, you'll concentrate them and they'll end up in your saleable product. So quite often you'll have to have a stage in your processing where you remove these, and you need some kind of technology to do that. And obviously that adds to the operating costs. And obviously you've got issues with worker safety. It's not just making a saleable product. Suddenly you're dealing with radiation, and you've got to deal with ionizing radiation regulations in whichever country you're working in. Now, and then we go on to the environmental and social considerations. When you look at that list of the stages of leaching, you know, it's, all right, I made the joke about vinegar, and maybe I just wish that the reagents were as benign as something like vinegar, but they're not. There are acids and all sorts of nasty compounds that you've got to use to do this leaching. So the facilities that you build to process rare earth elements are not going to be environmentally friendly, and you're going to have to do a good job to make them environmentally friendly and socially acceptable to the communities they're situated in. So look at the example recently in Malaysia with the rare earth refinery there that I believe it's been closed down. And I don't know what impact that's going to have on the world rare earths market, but I don't think it's going to be benign. It's certainly going to, you know, probably push more production back to China. So also it uses a large amount of water and a large amount of energy. So there's some environmentally challenging and socially challenging aspects to these projects that are probably going to be harder than a conventional mining project, because it's chemical engineering. And if you're going to have a project, you're going to need a route to an off-taker, a route to a processor or a refiner as part of your technical studies. And I think, as we'll see with the conclusions, is that you need to be absolutely clear how you're going to extract your product and where you're going to sell it to. So that has implications on the planning and execution of these projects. So if we just move on and have a quick look at the market. And another key point about the market is that the supply and demand characteristics for these elements are different depending on what they are. So some of them might be more in demand than others. It's not like a blanket, they're all in demand and they've all got high prices. That's not necessarily the case. And the markets are quite opaque. They're quite difficult to determine who's producing these, where they're coming from. It's not like there's a stock exchange or these products are freely traded. Stockpiles exist with various countries around the world, and we're not sure how big they are. And some of these rare earth elements are more abundant related to others. So that's a challenge. So lumping them together as we do as total rare earth oxides is not particularly helpful when you're trying to get your sharp pencil out and do a due diligence on it. Now, I'm sort of aware of time, but if we look at the prices, there's some recent examples here of what's happened to the prices, and you can see the prices have gone up, and that's going to be driving more demand for these projects. to come online. So that's obviously something in the mining sector we need. We need the higher prices to drive these things, especially given what I've just said about how hard they are to recover and process and make acceptable to the people who have to work at them or have them in their communities. Now, if we look at some recent headlines, you might have heard Elon Musk making comments about he's going to be building motors with magnets in them that don't need rare earth elements or whatever. And according to our research, we don't see any basis for that. I don't see the evidence. And also Tesla is not a huge impact on that market when you actually look at the numbers. So I think that it was just a bit of posturing for him, and he was trying to, I don't know, get people to sell him rare earth elements at lower prices or something. I'm not quite sure what he was trying to achieve. Now, on a lighter note, if you sort of look about what this means to your rare earth project, so that road to mining is going to be critically dependent on how you navigate this path to that destination. And you've got these, even though you might have some good results, you've got the challenges of metallurgy, the market, ESG, obviously in geopolitics as well, coming into it. And in the Grim Reaper there, we have Elon Musk playing the villain. Now, if we quickly just run through the risks. And I say, yeah, I've got 3 minutes left. I'm aware of that. Now, if we look at these, we can see that there's obviously a case for replacing these. If we can find things that are easier to replace them with, I think there's a very strong case for that, because these rare earth elements can be very difficult to find and extract. Also, some countries they'll withhold exports of some of these things. And we've seen that in recent years with China across a range of commodities. I mentioned about the radioactivity. One key point here is the scoping study versus the feasibility study. And I think the scoping study, you'll see on many of these projects, and I've had this personally on a battery metals project in Botswana for Guiani Metals. That was a manganese project, but the principle is the same. On that project, we did a scoping study, and when we didn't know much about recovering the metals, it was quite a fairly low operating cost. Of about $200 or $300 a ton for processing. But when we did the feasibility study work and looked at it in real detail to try and get a high purity product from a leached solution, the operating cost went up to $800 or $900 a ton. So that kind of study risk or execution risk, that it looks good at a scoping study when you don't know much, but the more work you do, the harder it becomes. And I think that is a very key point to make about these kinds of projects. I'll just click through these quickly now. I'm aware that I'm running out of time, Chrissy. Opportunities, I think there are great opportunities for these projects if you can crack the things that we were talking about earlier. And just to sort of sum up my key due diligence considerations is that you have to carefully consider the geology, the deposit type. The grade is something that is very, very tricky to sort of understand what it is and how it's derived. If there's metal equivalents used or total rare earth oxides, you need to understand those. You need to understand the process recovery of each one. Because it's like a basket of commodities and you don't know which one, where is the value in that? So beware. The other thing I'd say is that you have to have a pilot plant at an early stage with these kinds of projects. You've got to be able to demonstrate at an early stage that you can recover something saleable at a saleable cost is very important. And a pilot plant is about the only way to properly do that. And just one last point, I know I'm out of time, but the ESG factor can't be discounted as well, that you might find a perfect project, crack all these problems, and then still not be able to build it. So anyway, thank you very much for your attention. And I hope you enjoy the rest of the conference. Thank you.
Mike, thank you. So if people ring you up at home and ask you questions about your errors, I would have liked, the rest of you, I would have liked to have heard the rest of that. So next time either you book a 25-minute slot or we can come outside. What booth are you at?
I can't remember. You'll find it in there. It's not a big place, at the SRK booth. So yeah, come and say hello.
Yeah, it's an interesting topic. Thank you very much for putting that together for us. And I am sorry that we don't have all the time in the world, but we've got a very big program. And remember, we've got Auditorium 2 as well. We've got lots of things happening in there, and those talks in there are 15 minutes long. So things kind of go between 1 and 2. So you can jump between the 2 auditoriums. And rounding out this session here, we've got another panel session. Right, our first company presentation in auditorium number 1 for this session. We're going stateside and we're going to talk about boric acid, which is used, hello, there he is, I couldn't find you in the dark, used in more than 300 commercial and household applications. 5EA Advanced Materials is the company joining us on stage. They are the newest, or building the newest globally significant boric acid mine in the world. The company's story is multi-layered. And that's a little bit like your rebranding, isn't it, too? Because you're now a vertically integrated boron player. We're going to find out more. Would you please welcome this fellow, JT Strozecki, the Chief Marketing Officer. Welcome, sir.
Thank you very much for having me. So I think it's interesting and in a good link. We are somewhat tied to rare earths in the whole battery materials sector. So I think us following the SRK presentation is very apropos. And there's a couple of parallels with green technology that I think that we tick a couple of different boxes. So let me just kick off with a few, make our legal happy there. Let's talk a little bit about what the organization looks like from a financial perspective. We've got a very good set of analyst coverages that sit out there. I will talk about our overall resource and the value of which sits in the ground. We've got some estimated resource grades that are out there based on a proof of concept project that was done on the resource back in the mid-1990s. We've got inside ownership and overall top ownership at almost 60%. We're both dual listed on the ASX and on the NASDAQ. We were listed on the NASDAQ about just a little over a year ago. So a couple of points that I hope to be able to leave the audience with around the investment highlights. And specifically, I'll talk through a little bit of the supply and demand dynamics, the pricing mechanics, and this emerging supply gap that we're starting to see. But when I'm finished with the presentation, hopefully I'll have left the audience with a couple of different investment highlights. First and foremost, we've got a very large and rare asset. So in order to have a boric acid deposit, you have to have some geological items that come into place, all in sort of the right synchronization. Those are volcanic activity. You've got to have an evaporate sea basin, and you have to have geological faults in order to have a boron deposit form over the different centuries. So these deposits don't just sit everywhere, and that'll sort of play into this dynamic of how rare the boric acids are, the boron supply actually is today. We are in a strategic location with our asset. We're in the west coast of the US, so in California. And I know California is synonymous with non-friendly mining jurisdictions. We happen to be in the one county in California that is very mining friendly, San Bernardino County. There are 2 or 3 producing mines in that county today. So the strategic location, not only of where we are in the jurisdiction of California, but also the fact that we've got access to ports, rail, and all key infrastructures puts us in a very ideal location. We're starting to see this large supply-demand gap emerge when it comes to boric acid because of the applications in which it's used in. Historically, boric acid has been used in sort of lower-end products, or we call GDP-style growth drivers. So laundry detergents, you'll probably be familiar with the old borax laundry detergent. Low-end fiberglass, and then you start to move up the value chain, you get into fiber optics. And then most importantly, there'll be a lot of green and clean tech examples that I'm going to give here in a couple of different slides. We also have the benefit of having lithium as a co-product. With the way that we extract the material, we don't need additional infrastructure built on our project. So we have the benefit of not only having a large-scale boric acid supply, but also lithium carbonate as one of our co-products. There's also a stream of gypsum that'll come out the back, which does have an agricultural need. And being a former fertilizer person myself, I know for a fact that we've got a very captive market in the West Coast to use gypsum as a soil conditioner. So let's talk about what we call the pillars of the boron opportunity. You will hear, or if you've listened to some of our previous marketing messages, we talk quite a bit about these global megatrends that boron is fitting into. I'm going to take sort of another route with that, but first and foremost, right, we're all here because of decarbonization, this energy transformation that we're all taking part in. And boric acid has so many different applications in the energy transition space, whether it's EVs, whether it's wind, solar, and all the technologies that sit around that. There really is a proper space for boric acid and 5E as one of the newest producers of boric acid have to play. It's a very critical material that's used in a wide variety of these applications, and I'll show you a few examples here coming up. Boric acid is also used in fertilizers. So we have a play in the Global Food Security Challenge. It's used in NPK blends. It's used in fertigation technologies and fertilizers, has a very large market demand for boron-based fertilizers as micronutrients. Sorry, mic problems. Because we're based in the US, obviously critical onshoring of strategic materials is at the forefront of everything that we're trying to accomplish here in the US. We happen to be playing in a market that is dominated by two key players. You've got the Turkish government Eti-Maden conglomerate, which essentially controls about 65% of the global boric acid supply. It also sits on 72% of the world's reserves. And then about another 20 to 22% from Rio Tinto from their US borax project. It's about 80 miles from our project. So combined there, you've got about 85% of the boric acid global market is controlled by these two entities. And when we talk about this growing supply and demand gap that I'll be able to illustrate here shortly, you can start to see why that becomes a worrisome concept, particularly in this space. So we look at 5E as one of the solutions to this whole scarcity challenge. Very excited to be here today to talk a little bit more about what that means and what it's going to mean for the global market. This personally is my favorite slide in all of our presentations. I think it's a great graphical representation of just the wide range of uses that boric acid plays into. So not many people, when they think electric vehicles, think boron. The sexy thing to talk about is obviously lithium. Rare earths go into electric vehicles and the battery technology. But if you look at that magnet and the electric motor that sits in the center of the page, that's essentially a piece of technology that is 2 parts rare earths and 1 part boron on the backside. And there is no substitute for boron. So the mousetrap as we see it today and as we're utilizing it today doesn't work without boron. So we talk electric vehicles, we often talk about battery technology, but boron doesn't stop with battery technology. It goes into the chassis for the ferroboron steel. Essentially, boron is the second hardest material on the periodic table. With this ferroboron product being put in both electric vehicles and in fuel-powered vehicles, you're actually creating a chassis that is lighter and more efficient. It also goes into the additives. It also goes into the acoustics and the thermal insulation. So boron acts as a thermal capacitor, helping with items to become more efficient because it helps reduce the heat output. Solar, it has a great application in solar, both in the construct of the wind turbine blades, but then also in those electric motors and the magnets that go into those motors. So again, as we know, the wind technology today, it doesn't work without boron as one of the components. And then of course, solar. There might be some people in the audience that have heard of borosilicate glass, Gorilla Glass on your smartphones. So high tensile strength glass essentially sits on the outside of this solar panel, thus making it more environmentally resistant. So What we're trying to lay out here is boron has so many different uses, both in the green tech and clean tech space, but also in your everyday use. It's on the monitor. It's in the monitor that I'm staring at here. It's in the light fixtures. It's in the glass. There's 14 or 15 applications around the room that I can see that don't really exist in its current format without boric acid today. So what does that mean from an overall market perspective? Now, this is an excerpt out of a Credit Suisse report that was published a couple of years ago, where they took a look at both demand growth and the supply and demand imbalance that has been rumored, but now has data to show that it is very much upon us. So what they did is they took a look at the boric acid market, the boric acid equivalent market back in 2020. And today it's about 4.5 to 4.7 million tons of boric acid equivalent. They then overlaid and took nominal growth rates of 2 times and then sort of a bearish case or a bullish case of 10 times growth. And I think what's most important is not to sit and figure whether it's a 2 times, a 1 times, or a 5 times growth, but where that growth is coming from. And that's what's represented in the green boxes on the left-hand side of this graph. So everything in gray is what we'll call sort of older usages of boric acid, lower end, lower value use of the product, but still lots of consumption. But where Credit Suisse and most of the players in this sector see the growth coming is in all of these green tech and clean tech opportunities that I showed on the previous slide. We're now at a situation where then if you switch over onto the right-hand side, we're now in a situation where the supply and demand gap has started to separate itself. So in 2022, we had a situation where all across the globe, every cargo of boric acid was spoken for before it hit a port. We expect very much to have the same situation this year, but as the green technologies and the applications for boric acid in said technologies grow, we start to see this gap beginning to emerge. And that's very simply because there's not enough new production coming online. So I would bet everybody in this room is familiar with Ioneer. They're an organization that has a project somewhat similar in a similar location. But when you look overall at the portfolio projects that are out there, even at a concept level, there just isn't enough to meet forecasted demand. So what we've done here is we've broken down what the universe looks like when it comes to projects. And there's only 6 visible projects that would bring on new boric acid production in the next decade. Of those 6, you see them in very different stages. So when we look at exploration, we talk about desktop exploration. We talk about reviewing old drill work. We don't talk about anything that is sort of current outside of concept. And then as you move into drilling campaigns, you ultimately have organizations that move into the study phase. We'll put out a DFS, we'll put out a PFS, a BFS, and there are some of the organizations that have gotten to that level. Then you get to the all-encompassing, very crucial permitting stage. And that's where a lot of these projects start to stumble. I heard one of the speakers earlier in one of the roundtables talk about in Canada, just the lack of ability to get permitted projects pushed through in a quick fashion. We were very fortunate at 5E. We have all of the substantial permits needed for our project in place. In fact, we have a lot of iron in the ground. We are finishing the commissioning of phase 1 and we'll be turning on essentially the newest form of boric acid in the United States in the last 50 years. And then I mentioned the producers. That there's a few producers outside of Etimaden and Rio, mostly in South America. You have some production in Chile, Peru, and Bolivia, but it's a different ore body. So it has a lower B2O3 content. But that's essentially what the universe looks like. So as you think back to that widening supply and demand gap playing out, and you have fewer and fewer projects that even have boric acid as a potential, you can start to see that in 5 and 10 years from now, we're going to be in a really tough situation from a global market perspective. Now's the time I get to brag about the 5E Boron Americas project. So we are in a very ideal location because of all the access to key infrastructure. So a little bit of background, this project itself back in the mid-90s was operated as a proof of concept project. So there were exploratory wells dug in a well field. There was acid that was injected, boric acid came out and was produced. The whole reason for that was essentially a proof of concept project to go find investors to actually build out a boric acid plant. Two problems in that sense that one, they were not able to locate investors, and the boric acid prices were at sort of what they've been historically, which is somewhere around $550 to $600 a ton. In today's world, it's around $16.50 a ton. So you take this same asset and you apply current pricing methodologies to it, and you can see all of a sudden we've got a very viable project. As I mentioned, the key permits are in place to deliver up to 90,000 tons. We are extremely close to actually starting production. So we're completing the commissioning of phase one. We do have a very large resource at today's market prices at 327 million tons of product. You're somewhere in the neighborhood with both your boric acid and your lithium content in the neighborhood of 80 to $100 billion in the ground. We have a low impact mining method, so it's in situ leaching. Essentially, you have a large well field where you inject a diluted acid down one side, extract back up, and you have what we call a pregnant liquor solution, or a PLS. It goes then through an evaporation stage, goes through a crystallization stage, and that's where we essentially separate the boric acid, which comes out as a finished product, and the lithium carbonate. We do have access to all key infrastructure. So we've got the BNSF railroad that runs to the deposit. We have the permits to build a rail spur should we decide we want to connect via rail. We're close to Port of LA and Port of Long Beach. We've got gas pipeline, high voltage electricity, and most importantly, we have our water permits. So we are already permitted to utilize 650 gallons per minute. We're very fortunate with the way the deposit sets up that we've got aquifers on two sides of the deposit that are deemed non-agricultural use and non-potable or human consumption use. So it's permitted for industrial use only. Makes us very fortunate having a project in the Mojave Desert to have access to all of that infrastructure already in place and to have access to water to actually extract the material. So what you're seeing on the left-hand side is what we've built. So that is the iron in the ground for our phase 1 5E Boron Americas complex. We're at the end of the commissioning stage, when just around the corner from production. As I mentioned, we've got all visibility and access to the necessary infrastructure. And right now our resource estimate has us somewhere, if we were at a run rate of about 500,000 tons of boric acid per annum, that gives us a mine life of about 40 to 45 years. So long life, multi-decade asset for a very key material. From a capital markets perspective, I mentioned that we are listed on both the ASX and the NASDAQ. We are subject to the difficult capital markets that a lot of us are struggling with today. But we do have a diversified investor base that has been very, very loyal to us. And we hope that as we get through the next iteration of the company, we can start to reward those investors. The commercial dynamics are very much in play. So we've got blue chip companies that we're discussing offtakes and different structures with. We also have some very good partnerships from an R&D perspective that look at different types of solar technology, wind technology, and even battery technology. What can we expect for catalysts to come? A lot of items around our construction. So essentially when we turn the plant on, that's going to be a big milestone for us. So that phase 1, as I mentioned, is almost at the end of commissioning, and we expect to be able to start producing boric acid and lithium carbonate before the end of second quarter. We've got these commercial partnerships that we're working on, and we believe will be a good catalyst from a market perspective. And then, of course, engaged in all of the government funding activities that are in the press these days. We've got opportunities for piles of money from the Department of Defense, the Department of Energy. And because our product is used in fertilizers, there is a pot of money that we are chasing from the USDA. So all of that will make up part of our cap stack as we move forward. So really quick, in the 14 seconds I have left, we're about to release a revised SK 1300 that is going to show a very modular approach to building. It's going to give us a streamlined path into production as quickly as we possibly can. It's going to allow us to have a manageable CapEx number, which then ultimately allows us to, as we start to construct this larger scale initiative, we can then take this phase one and we can start to create downstream derivative products that are boron based, which then ultimately gives us a very good, compelling story for the upside for advanced materials. I almost did it in exactly 15 minutes. I'm 30 seconds over, but I'll pause there.
Thank you. I should explain myself, JP, because what I do is I need to wait until you've finished speaking, give it a little break there so they can cut it all up for the ASX. So I do stand there like a bit of a mute at the end, but I'm just trying not to over talk you so you have a beautiful, clear piece. Thank you for sharing that with us today. It's a very interesting project.
Thank you. Appreciate it.
Thank you. Put your hands together again for JP, everyone. So our next company up on stage finished 2022 in a slightly enviable position, didn't you? What did you put up there? There was a 580% oversubscription to their share purchase plan. You'd need to be a bit happy with that, wouldn't you? Correct? All right. Well, you keep walking and I'll keep talking and you get there and give more time to talk about it. So Arafura's Rare Earths project in the north of Australia is what we're going to talk about next. This is their MD, Gavin Lockyer, and we're going to find out what it is that's catching the eye of investors. We're going to dig a little bit deeper into the worlds of neodymium and praseodymium. Please make him welcome.
Well done. NdPr is what we usually say. It's just easier. Thanks everybody for your attendance today. It's always the hard gig straight after lunch, so I appreciate you coming and showing interest in Arafura. As you heard, my name's Gavin Lockyer. I'm the Managing Director of Arafura, and we are building the Nolans Rare Earth Project in Central Australia. I know you've heard critical minerals and rare earths, et cetera, probably to death today. So I won't dwell too long on this, but the key thing to remember is that NdPr or neodymium iron boron magnets, as you just heard from the previous speaker, are the building blocks of electric vehicles, but they have many other applications as well. And they really are changing the world in terms of renewable energy through more efficient offshore wind turbines, and obviously electrification of auto fleets. Our project itself, whilst it sits in the middle of Australia, which some would say is quite remote, we actually are not isolated. We have a lot of very good infrastructure very close to our site. The project is at only 130 kilometres north of Alice Springs. Alice Springs is a town in Central Australia of about 26,000 people, has daily flights to every capital city, unfortunately, except from my hometown, Perth, every day. And so it's very accessible for bringing in workforce. The Stewart Highway dissects Australia north-south, and we literally sit 10 kilometres to the west of the highway. The red line in the diagram at the bottom, you can see there, is actually the existing Amadeus gas pipeline, and that is taking gas from the Amadeus gas basin in the south to Darwin in the north, and it's about to be connected to the East Coast grid. There's surplus gas in there for our power requirements. And back in 2013, we undertook an extensive exploration program to try and find water in the region. For those of you that know, obviously Central Australia is quite an arid region. We were told by all the locals, including the traditional owners, that there's no water there. We did some fairly clever science, re-engineering the geophysics of the region, identified 12 potential drill spots, and every one of those was wet, and some of them only 20 metres deep. And you look at this country and it's just sandy spinifex scrub. You wouldn't think there's water there, but there's water there. It's a significant new water resource for Australia, and already we've been able to provide a permanent water supply to some of the local Aboriginal communities in the region. That water resource has been monitored since 2013, and we've got our water licence in and all our environmental permitting such that we can fully operate the mine in a sustainable way. Delivering to an ESG world, this is something that we're hearing a lot of at the moment, and it's certainly, in my experience, been really poignant in our funding strategy. The off-takers that we're speaking with are demanding ESG credentialed raw materials. And in the EU in particular, the auto sector has realised that they're not just allowed to go back and look at the magnet producer that is producing components for their automobiles. They actually have to go back through to the raw material. And that's where Arafura becomes very important, because by operating in Australia, a very well-defined mining jurisdiction with strong environmental permitting application, bureaucracies in place, it certainly is a selling point to our customers. And that's why we were extremely pleased that Hyundai signed a binding agreement with us late last year, and we currently have a non-binding MOU with General Electric. And one of the key things that pushed them over the line in our discussions was our ESG credentials. And many of you would be aware, being in the mining industry, that Australia would typically dig things up and ship it offshore for processing. We're actually doing all the processing at one single site in Central Australia. And why the customers like that is because it provides them with provenance around supply chain, but also they can see that the waste is being managed by the company, and basically we're putting it back from where it came from. And this has been a really big selling point for our project offshore. Late last year, we were very pleased to raise $140 million, as Christina alluded to. It was heavily oversubscribed, both in the placement level and also in the just in the more wider offering to shareholders. That was cornerstoned by Hancock Prospecting, who are now a 10% shareholder of us. They had been accumulating a position on Arafura throughout that year. And when we went to them and said, look, we're looking to raise some money to push ahead with the project, they jumped at the chance, which was extremely pleasing. What that has allowed us to do, in January, we started ordering the long lead equipment items, so some of the key pieces of the hydrometallurgical plant. They are now on order in Germany, predominantly. But it's also allowed us to commence early works ahead of building a full-blown construction later this year. We've just completed roughly 30 kilometres of access roads. We've laid concrete for the fly camp, and this month we'll be commencing earthworks for a 400-person permanent camp at site. So really exciting times. All the project team is obviously very excited, but we still have to finance this project. And that's been the main commercial activities over the last couple of years, really. But they're in earnest as we speak, raising the debt and the equity that this project needs to get to financial close. We're hoping by the middle of the year so that we can be in full-blown construction in the third quarter. As I said earlier, we're fully permitted. We have everything, all our Indigenous land use agreements, our mining licenses in place, and our environmental approvals are all done. Support from the federal government, as you heard from the minister this morning. We've also undertaken a very extensive technical program historically. These things aren't easy to do. You can't just drill a couple of holes and suddenly you've got a rare earth deposit. You've got to understand the metallurgy, the chemistry that goes with it. Every rare earth deposit is slightly different. And so we've spent a lot of time piloting, testing, chasing rabbits down holes, and sometimes finding ferrets. But I'm pleased to say that in 2015, we locked in the flow sheet, and then we undertook an extensive at-scale pilot program. That pilot program took 12 tonnes of material from Central Australia. We then took that to Perth at SGS and undertook the various units of operation at scale. In order to try and eliminate some of the commissioning error, commissioning problems that perhaps were experienced by others, we got expert equipment manufacturers to come provide their equipment. have done extensive corrosion testing on materials of construction. And some of those orders that we've now placed are with those very OEMs that came and helped us with the piloting. So we hope that some of those commissioning issues have been eliminated. We've also engaged with Hatch very early on in the stage to make sure that the pilot was done at a reasonable scale, such that when we go into further engineering design, that they had some input there. So Hatch has been with us since day one. In this, they went through the feasibility study. They informed us for the feasibility study. They then undertook a front-end engineering and design process. And at the moment, we've just expanded our office space to another floor in Perth, and currently have our entire most of our engineering team, which includes in-house engineering plus KBR and Wave, sitting alongside Hatch, alongside Monadelphous, our potential constructor. And that has enabled them to start an early contractor engagement phase. So all the three areas are not siloed, they're all talking to each other. And we're finding that that's been a really good move for us. There seems to be a lot less disputes, I guess, going on between the various parties. So whilst Hatch are completing the detailed design now, they're informing and being informed by Monadelphous. And the target is, as I said, to be in full construction by the third quarter of this year, funding pending. Just a few comments on the NdPr supply. You've all heard the story today. I won't bore you with it again. It's being driven by basically renewable energy and e-mobility. And by 2032, about 52% of demand will be contained within the automotive sector or the renewable energy sector. Which really means if you're a OEM in those sectors and you don't have a strategy for procurement supply aligned with the China Made in 2025 policy, you're going to be very much left behind, because as I heard from one of the speakers earlier today, China is and are actively out there looking for resources to feed China's own demand. They want to be the leading EV maker in the world. They installed more offshore wind capacity last year than the rest of the world has done in 5 years. They're serious about ESG, and they've got I guess the clout to do it. So that's why we've targeted our offtake strategy into those regions where we can see a strategic advantage for the customer to have a diversified supply chain, which we can offer. Which leads me into the offtake. As I mentioned, late last year, we were very happy to sign a binding offtake agreement for 1,500 tonnes of NdPr oxide or metal equivalent with Hyundai Kia. That represents about 30% of our nameplate production, but you can see there it's about 40% of our binding offtake target. As we've progressed our discussions with the lenders, they have instructed us or prefer us to have some binding offtakes with tier 1 groups and up to about 85% of our production. So that's what we're targeting. We've got contract negotiations in very advanced stages with probably another 4 groups, 2 wind OEMs, 1 magnet producer and 1 automaker. We're at very advanced stages. Some of those might not be announced because the customer doesn't want them announced, and others will be announced, we hope, in the next couple of months. And GE has been one that we've already named publicly in a non-binding MOU. Most of the offtake discussions also talk about potential equity participation. Certainly Hyundai and GE, we're in discussions with them about putting equity in at parent company level, and those are progressing nicely as well. And as I come back to the debt and the financial close, we're targeting all of this by around the middle of the year. The last group there, which is the advanced offtake discussions, not quite as advanced as the ones as the category above, probably another 10 customers. And what we're doing at the moment is, because of they're now starting to come to us, and there's a bit of a fear of missing out going on at the moment. And so what we're taking some extra time to do is actually try and negotiate some better outcomes for Arafura. Previously, it was the buyer or the OEM had the weight to throw around. Now they're starting to realise that there's not enough product at the moment in coming through in the supply chain in the next 5 years. And so that's a benefit for us, and we're hoping to make the most of that for our shareholders. The overall funding itself is we've basically been running a debt-led funding strategy. For most of last year, our market cap sat around 300-400 million Aussie, with knowing full well that we've got a $1.6 billion project. So we needed to focus on what we could control and not the equity markets. We focused on the offtake and we focused on the debt. Last year, we were very pleased to announce that we've appointed SocGen, NAB, and also KfW, the German bank, as mandated lead arrangers. And KfW have been coordinating with export credit agencies globally. We have received $350 million in total from the Australian government through the NAIF, Northern Australian Infrastructure Fund, and Export Finance Australia. And last week, we announced that we had a US $600 million potential facility from Euler Hermes, the German group. So between those two groups, and we're hoping to continue to work on K-Shore in Korea, we will certainly have the majority of our debt, as how we term it, covered. So it's been covered by an ECA guarantee. The beauty of this is that it provides us with a long tenor. So some of this debt is between 10 and 15 years, which certainly helps us in the early years when you're trying to commission a plant and you might not be hitting nameplate production early on, but you still have basically to meet your debt covenant ratios. With the on the equity side, as I said, the plan is to align our strategic off-takers, our strategic investor in Hancock, and go to the market a bit later on in the year once we've identified the debt stack and have that locked away. We then know exactly how much equity we need and then go out and do that raising, but have it significantly cornerstoned before we hit the market. Just as a couple of key takeaways, and then I'll have a couple of minutes maybe for questions if anybody wants any. But we are an advanced ore to oxide project. We're not producing a mixed rare earth carbonate. We're focused on NdPr oxide. That is 85% of our revenue. And the only other rare earth product we're producing is a mixed heavy oxide. And we're not going into further refinement there. So ore to oxide at a single site, which helps feed into a diversified supply chain. So our oxides can actually be processed into metal, alloys and magnets outside of the Chinese supply chain. And we have a tolling arrangement with metal producers should our customers prefer to receive metal to be delivered to their preferred magnet supplier rather than receiving a rare earth oxide. The cornerstone binding offtake agreement with Hyundai Kia, I can't express how important this has been to the company. I believe we're the only rare earth project out there that has named a tier one OEM automaker as its customer. I think most other projects are delivering product through effectively trading houses, or they're not producing an oxide. They're producing something further up the chain, which has to go to China for processing. Debt process is really well and truly underway. We've got advanced term sheets with the lenders currently out there. We hope that all gets through credit in the next month or so, such that we can then identify the final debt stack for the equity component. We have spent the last 12 months or so engaged with the independent technical expert, SRK, for the lenders. They've now completed their process. And I'm really pleased to say that because we put a market update on capital and operating costs out in November last year, that the CapEx and OpEx in that SRK report were quite aligned with our existing numbers. So that was pleasing to see. And just finally, obviously, raising money is always good at our end of town. That capital raising has now given us a market cap of well over $1 billion Australian dollars. And it's allowing us to now de-risk the construction schedule. Thank you, everyone, for your time.
Thank you very much, Gavin. We'll leave it there. Thank you, sir, if that's all right.
Thank you.
Less of me, more of you guys out there. Dreadnought Resources is next up on stage. Dean Tuck, can you come and join us, please? Dean is the Managing Director. Dreadnought is a West Australian mineral explorer focused on discovering the minerals for our future, and he's going to give us an update today on the exploration across its portfolio of critical metal projects.
Sometimes I get a good feeling. Yeah.
Good afternoon, everyone. It's 2 p.m. We're all falling asleep, I believe. And working with Colin at CAD Innovations, we decided we'd have a bit of fun, try and perk some people up with a lively presentation today. So please bear with me as it's a bit different to my normal ones. Thank you, everyone, for being here. It's an absolute pleasure to be here in Singapore, my wife and I's favorite city to come visit. Such a beautiful and wonderful place and a fantastic first event, and I look forward to coming here for many years to come. Today, talking about Dreadnought Resources, there's been a lot of presentations on discussing the metals required for the clean energy revolution, the low carbon future that we have. Everyone, that's why we're here. So you're not going to hear that from me. I'm an exploration geologist. We have a project, we have a team that delivers discoveries and generates value for our shareholders through the most significant value creation phase of the resources industry, and that's discovery. And you look at Chalice Resources, who was up here as almost a keynote head of BHP, which was fantastic to see. You know, that wasn't that long ago. They were a 10 mil EV, and now they're a $3 billion company. Liontown Resources, you know, they were 20, 40 mil. And now they're 5-6 billion through that discovery and through development of projects, especially forward-facing commodities. And Dreadnought has quite an exciting story that I'm looking forward to sharing with you as we have talk about our rare earth discoveries, our copper, our nickel, and other assets. Typical disclaimer. Most of the presentation today will be about our rare earth project. We have 4 company scale projects, and we talk about this. I believe we have more land under a tenure than the state of Delaware in the United States. You know, each of our projects is 1,000 to 4,000 square kilometers of ground because we are a greenfields explorer. We have probably one of the best teams put together anywhere out there on the market to deliver discoveries in these new terrains that are elephants, the big discoveries like the Julimars, like the Liontowns. The first movers to go into these regions are the ones that make the big discoveries. We have a few discoveries under our belt and across each of these projects, and more to come. So Mangaroon, first up, just next door to Hastings Technologies Yangibana project. This will play a very significant role in the rare earth play because we're probably the only rare earth explorer with a second mover advantage. But we pegged this ground at 4,500, over 5,000 square kilometers now, originally for the nickel and the high-grade gold. That nickel we quickly proved existed, high tenor blebby sulfides at surface. We've drilled that. That's been confirmed as a very fertile system, and we're being free carried with our joint venture partners, First Quantum, on that project at the moment. They're spending $12 million to earn an initial 51% of that project, and we'll be drilling some exciting targets out there later this year. And when we do, we'll probably drill some of our high-grade gold targets out there too. But the rare earths, that's what's driving a lot of the interest in the market at the moment for Dreadnought, and that's sitting down here on our 100% owned ground, quite far away from the First Quantum joint venture. We have 2 styles of mineralization in regards to rare earths out here. They're both carbonatites, but one's an ironstone carbonatite dike. It's a siderite-dominated ironstone carbonatite intrusion. And then you also have the big bulk carbonatites, which we discovered late last year and have continued to put out high-grade polymetallic results across those. Very early days, very exciting to see what continues to come from that. But the ironstones is what's our second mover advantage, and that's where we got started. We found ironstones kicking out of the ground. We have high NdPr to trio ratios. So we talk about earlier, people talked about how we have 17 elements and you only get paid for about 4 of them. So when you look at the concentrate that can be produced from these ironstones, it has a very, very high proportion of the actual payable metals in it. So it's a very high quality con if we can continue to prove it up and prove to make that con. So de-risked metallurgy. Before we drilled a hole into this thing, we already proven that we could we could produce a sellable concentrate product. So moving in on yin, this is where we started. So we only started drilling our first hole into yin was in June last year, just 9 months ago. Over a 6 to 8 week period, we drilled 129 holes. And in December this year, we put out our first resource over that yin, that first 3 kilometers of trend. Resource there, 14.36 million tons. It's a nice starting place with a high grade component sitting there as well. One of the things that people have talked about is trio. Trio is, it's somehow you can get away with reporting trios like a metal equivalent without proving any met. So one of the things that you'll start seeing us putting out, like Northern Minerals has for Brown's Range, you'll see there's 3.4 kilograms per ton neodymium praseodymium with a higher grade component that's 5.7 kilograms per ton. So kilograms is how the rare earths are priced in. You can download the Shanghai Metals Market SMM map, and you can see live rare earth prices all the time. So cerium, lanthanum, we're focusing on the neodymium praseodymium. So we have high trio ratios as part of that. We confirmed monazite in the oxide and in the fresh, and we also have bastnasite and rare earth carbonate sitting in some of that fresh material as well. And our metallurgy confirmed before we ever drilled a hole, we carried out 60 to 80 kilos of rock, took it down to ALS, who had developed the MET flow sheet for Hastings, put it through the exact same flow sheet that they had developed over 10, 15 years, and proved that we could produce a 40% monazite con at 93% recovery, just under 93% recovery. Now, that was based on the outcrop. We have 19 holes at the lab now. We should have assay metallurgical results out this month or next month. And that'll be the start of our metallurgical program to see if we can't finesse that for our product area. So very exciting to have that proven before we even started. And then we have a place to start with a proven material and see if we can improve on that further. Taking a step out, alluded to that was just 3 kilometers. At the end of last year, sorry, put a quick section up first. Looking at the Yangibana region, say that Hastings is going into development next door. When we put our first 6 drill holes into Yin, the first drill holes we put in, each of those was thicker and higher grade than was anything that region had seen before. So you have a mine going into production next door, fully permitted, everything's going, and we've come along next door, proven met and all the rest, and delivered some of the highest grade and thickest intercepts that region has seen. It's a fantastic spot for us to be in. Taking a step out, we put out an exploration target in the top 150 meters of surface of 50 to 100 million tons on top of the resource we had already defined. And that excludes the carbonatites, which I'll talk about shortly. We are now commencing that first pass program across the ironstone trends to test that exploration target. And we are targeting 30 to 50 million tons of ironstone resource. Now that's putting a minimum and a maximum on that. We're not going to continue drilling this thing until the cows come home. We're looking at actually getting to a base amount in order to sustain the 10, 20-year mine life and dig into that study work, prove the economics, and get into production as quickly as possible. Now, I've heard other companies talk about producing, you always have the $1 to $2 billion CapEx charges for building MREC facilities and the rest. And as we see a diversification of that midstream processing outside of China, you have Iluka building a rare earth oxide refinery just down the road at Iniaba, designed to take monazite. You have Energy Fuels in the US taking over monazite mineral sand projects in Brazil, so they can process monazite concentrates. So all of a sudden, concentrates, and if you can produce a high quality, high value concentrate, like we believe we'll be able to from this project, there'll become a lot of viability for us to generate revenue with a small CapEx requirement and not the big $1 to $2 billion. And said we have resources being defined out there at the moment. Taking a step back, I'm going to look over now about 10 kilometers away from Yin, we have our first carbonatites. Now the carbonatites, this is the big intrusions. These things have the potential to be like a Mount Weld, a Bayanobo, a Palabora, Arasha. It could be anything. I think when you look at exploration, the studies have been done, you have a 1 in 1,000 or 1 in 10,000 chance of a prospect becoming a mine. When it comes to carbonatites, it's 1 in 10. They're quite beautiful, exotic rocks with amazing polymetallic mineralization. You don't know what you're going to get. So we did some drilling recently, hit some nice niobium to go along with some of our rare earths. So we're just getting started on this program. We have identified these through geophysics. They do not outcrop. And so we've done a first pass drill program that we commenced last year. We're recommencing that program this week as we speak. We have a rig going out there. And we're trying to drill out on a very broad spacing, 160 by 160 meters, to find out where within these carbonatites is the rare earth mineralization. When you look at carbonatites, they tend to be quite large intrusions, and then within them, they have a zone of rare earth mineralization, a zone of fluoride, a zone of phosphates, and a zone of niobium. So we're going through and focusing at front on the rare earth potential, and so we're scanning through these carbonatites and finding out where is the rare earth halos or zones within them. Our first pass work, I said, is 30% complete at the end of last year. We had our Christmas break because it gets up to 46 degrees up in the Gascoigne, which isn't very nice, and my team would mutiny on me. So we're now back up there getting into this. But before we left, part of that first pass program, we identified what we call C3. That was a 600 by 550 meter mineralized footprint within the C1 to C5 carbonatite complex. We identified both fresh and supergene mineralization within that. We have mineralogy work underway. We have already confirmed coarse monazites and rare earth carbonates. And our next steps here is the follow-up drilling. We have 24 holes to drill. We've drilled 7 of those. And the big questions around C3 for us is this a bulk 1%, 0.5% sort of rare earth product? What other elements does it have with it? Or within it, does it have a high-grade component? And that's what that follow-up drilling is designed to do. And that's showcased by some of the niobium results. There wasn't that much niobium in our first pass vertical drilling, but as we did the infill deep angled holes, some of these holes came up with 30 meters at close to 1% niobium, 15 meters at over 1% niobium. And we didn't see that in the first pass holes. So this cross section behind me, that illustrates the shallow vertical holes that we drilled across the carbonatite, and then the infill holes, which we're currently drilling. We drilled a couple of at the end of last year, which test that carbonatite down to depth to see where within that could be the controls on higher grade mineralization. Stepping out again, zooming back out, we're only a third of the way through that first pass product. So like we have questions about C3 and what it could become. Is there another C3? Is there better mineralization? What else is going to be in that C1 to C5 complex? And also what's going to be down at C6? We should be drilling C6 hopefully next week. As soon as we get down there. Pad prep has already begun, and we're looking forward to finding out what C6 is. Because C6 has a very similar geophysical signature to some of the more classic carbonatite intrusions. Like Mount Weld there, we have a big magnetic and a big gravity anomaly. So again, completely undercover, could be nothing, but this is exploration, this is what we're out there to do. So we'll put holes into this in the very near future, and we'll find out what C6 is. And if that is what we hope it is, then we're going to hit it pretty hard. And that's going to be a very exciting, significant upscale opportunity for this project, in addition to the ironstones and in addition to what we're already seeing at C1 to C5. So what does that all look like summarized for the rest of the year? We have framework drilling and resource drilling on the ironstones, and then resource upgrade work to feed into the study work. So we'll have a yin met work should be out in April, May. Upgrade on the yin resource, which should give us additional tons, but also indicated potentially some measured resources on that. And then later in the year, we'll try and aim to deliver that 30 to 50 million ton resource to really underpin the study work. In parallel with the ironstone work is the drilling on the carbonatites. Finish that first pass work, find out what we actually have there. Is there a Mount Weld? Is there a mountain pass? We'll find out with that first pass work and follow that up accordingly. Kimberley, Mangaroon is not the only cab in the rank. So we do have a few other projects, which I'll quickly blitz through, because the Kimberley is what we're listed on initially. In 2020, we delivered an Orion copper gold cobalt discovery. This year, we'll be proving up finding its friends and then positioning ourselves for next year, delivering additional resources and commence studies. Bresnahan, the latest project that we added, was a conceptual heavy rare earth play. So in 2018, the exploration model for the Browns Range deposit, which is owned by Northern Minerals, which is the only real heavy rare earth projects outside of China. We were probably the first company to take that model and apply that to project generation. We're able to secure over 3,700 square kilometers, mostly vacant ground, and proved concepts of heavy rare earth mineralization late last year. We'll aim to get that ready, drill ready for next year. And Central Yilgarn, bread and butter, greenstone belts, 220 strike kilometers of greenstone belts. We've been working over the last 9 months on a nickel review. We believe we could have the next Forestania, Lake Johnson belt sort of style potential for nickel mineralization. We'll be generating and defining those targets this year and have those drill ready for the end of this year or early next year. So I believe I'm out of time, so I'll go through. We're fully funded for each of these work programs that I just told you about, which is highly exciting. Board and management, we have a lot of cash invested in this company, and 15%. I'll skip through some of these things, our story of discovery, and finish off quickly with the dream team. This is the guys and gals of Dreadnought. And
Here we go, boys. Come on.
There's nothing like an excited geologist, is there? I love it. Thanks, Dean. That's good. Just go and have a chat with him afterwards. They're a really great team out there at Dreadnought doing some amazing things. AIC Mines is a growth-focused, Australian copper mining company, and they own the Eloise copper mine. That's located over in northern Queensland. Back in January, your market cap surged, didn't it, sir? $23 million they went up to. So this is Managing Director Aaron Collyer, and he's here to present the very compelling AIC Mines investment proposition to you all. Please make him welcome.
Thank you. AIC Mines is a copper mining company. We have the Eloise copper mine located in North Queensland. AIC Mines is one of a very few number of opportunities on the ASX to invest in a pure play copper company. A copper company that is currently in production, that is expanding production, that has a well-articulated growth strategy, and is led by an experienced board and management team. Let me run you through the AIC Mines investment proposition. We have an experienced board. They've built mines and built companies before. They have the experience and expertise required to make AIC Mines a success. Joseph Alraghi, our chairman, was MD and then executive chairman of London and Toronto listed Centamin Limited, where he built the massive Sukari gold mine in Egypt. Myself, prior to joining AIC Mines, I was head of business development at Evolution Mining for the 10 years from inception as Conquest Mining. Many of the team at AIC Mines are also previously worked at Evolution Mining, and you'll see many similarities in our growth strategy and in our high standards. Our CFO, our Chief Development Officer, our Head of People of Safety, our Head of Project Development are all ex-Evolution Mining. Our substantial shareholders are FMR Investments, Firetrail Investments, and our Chairman. Just below the disclosable 5% level is a veritable who's who of Australian resource funds, including both of the major sponsors of this conference, Tribeca and Argonaut. We have 462 million shares on issue with a market capitalisation, sorry to correct the introduction I just received, of $194 million based on our recent share price of 42 cents per share. We are currently covered by 4 analysts, all with buy recommendations. George Ross at Argonaut has a 76-cent price target on A1M. George is here at the conference. Dan Roden at Jefferies has a 65-cent price target. Paul Kaner at Ord Minnett has a 70-cent price target. And Peter Cormandy at Shaw and Partners also has a 70-cent price target. 3 events, though, have conspired to push our share price down recently. Presenting, though, for you, an excellent opportunity, an excellent buying opportunity. Those 3 events. Firstly, we've seen a lot of flow back from the Demetallica takeover that we closed in December last year. The takeover acquired the Jericho copper deposit, a great acquisition for AIC Mines and very value accretive. But rather than participate in the upside in AIC Mines as we developed the Jericho deposit, a lot of Demetallica shareholders cashed out and moved on. That selling was a weight on our share price that we didn't need earlier in the year. Secondly, production at Eloise has not met expectation over the last 2 quarters. We are addressing this, and I will run you through how in more detail on a later slide. Thirdly, recent heavy rainfall in northwest Queensland has had significant impact on some of our neighbours. Eloise was largely unaffected. However, there was some contagion as investors assumed the worst for Eloise. All of this is now behind us, well behind us. So it's onwards and upwards from here, and I would posit now is a great time to buy AIC Mines shares. Eloise is a high-grade operating underground mine. Ore processing is via conventional crushed grind float to produce a concentrate. All of our concentrate is currently trucked to Mount Isa for the Mount Isa smelter for refining there. At full capacity, the current operation should produce approximately 12,500 tonnes of copper and 6,000 ounces of gold annually at an all-in sustaining cost of approximately Aussie dollars, $4.50 per pound copper. We've not achieved that run rate this financial year as we recapitalise the operation and transition to more productive areas of the mine. I'll talk more about the current production on a later slide. Eloise appears to have a relatively short life based on the current reserve and resource position. This is not the case. The relatively small reserve and resource position is a function of the geometry of the mine, its depth, and access to drilling platforms. The deposit is not drilled out. Most of the known areas of mineralisation remain open, either along strike or at depth. Ongoing drilling is continuing to replace mining depletion year on year. There was no better example of this than our updated mineral resource and ore reserve estimate released last week. Exploration and resource definition drilling completed at Eloise over the 6 months to the 31st of December 22 saw a 20% increase in mineral resources and a 42% increase in ore reserves after mining depletion. We expect to be mining at Eloise well into 2030 and mining in the region well beyond 2030. When we acquired Eloise in November 2021, we said that we would add value through exploration success, resource growth, operational reliability, and regional consolidation. We've delivered exploration success and resource growth, and we expect to continue to do so. We have commenced the necessary recapitalisation of the mine to deliver operational reliability. The standout value add opportunity was to consolidate the stranded deposits in the region to both expand and extend the production at the Eloise processing plant. We kicked off that consolidation late last year with the successful takeover of D Metallica Limited, who own the adjoining tenements covering 2,000 square kilometres and importantly, the 9.8 million tonne Jericho copper resource. Jericho is a perfect fit with Eloise. It is located only 4 kilometres from the Eloise processing plant and has similar geology, mineralogy and metallurgy, meaning that we will use the same mining methods and the same processing methods that we are currently using at Eloise. Jericho allows us to expand the Eloise processing plant and lift production to over 20,000 tonnes per annum of copper and 10,000 ounces of gold annually. It will reduce our operating costs through economies of scale. It increases the mine life and it de-risks production by increasing the number of available ore sources. Development of Jericho transforms Eloise into a true cornerstone asset for AIC Mines and cements our ambition to be a new Australian mid-tier copper and gold mining company. Jericho currently hosts a resource of 9.8 million tonnes grading 1.8% copper and 0.4 grams per tonne gold. It is open along strike and at depth. Also, importantly, it is shallow, commencing below only 50 metres of cover. The diagram on this slide shows you why we're so excited about Jericho. It highlights the relative depth of the Jericho resource compared to Eloise. We are currently mining about 1/3 of our ore at Eloise from the deeps, which is 1.5 kilometres underground and a haul distance of 12.1 kilometres uphill to the plant. Our shallowest current ore body is the Macy North deposit. It's our main ore source in 2023. Jericho is shallower than Macy North. So the current Jericho resource is larger than the current Eloise resource, shallower than the shallowest Eloise deposit, and is a shorter average haul distance to the mill. We're excited about Jericho and we're keen to get started on the development. Our initial estimates are that the Jericho development and Eloise expansion will cost roughly $85 million, made up of $25 million for studies, drilling and early works, and then approximately $35 million for the Jericho box cut and decline, and approximately $25 million to expand the Eloise processing plant. We currently expect the plant expansion will take a minimum of 12 months to complete, and that the Jericho box cut and decline will take 12 to 18 months to reach first ore. The capital cost estimates and construction schedules are early stage estimates. I must stress that. The mining, processing and engineering studies that are currently underway that we're completing this year will firm up the cost estimates and that construction schedule. Like most Australian copper and gold mines, Eloise has had a tough run over the last 12 months as it's had to deal with cost inflation, high employee turnover, supply chain issues, and recently high rainfall. Improvements are underway though. Access to the ore from the Macy North deposit was achieved on schedule on the 1st of March. And Macy North is a much more productive deposit for us because it is closer to surface. Our truck rebuild program is now having an impact with 2 rebuilds recently completed. Pybar, our development contractor, has recently taken over the trucking of development material, effectively adding 2 new trucks to our fleet. And independent firing of development headings in the deeps will commence this month to further improve productivity. So we are expecting higher tonnes, mined at a higher grade, delivered into a higher copper price, with reduced capital expenditure in the second half of FY23 compared to the first half, all leading to improved cash flow. The exploration potential at Eloise was one of the main features that attracted us to the acquisition. There are clear extensions to the main deposits, and we also believe that there is potential for satellite deposits shown on this diagram in the orange colours. The exploration that we have completed this financial year on the West Corridor has successfully traced the Macy North deposit further north, and on the East Corridor, we've made a new discovery at Lens 6. The Lens 6 discovery is a great example of what is still to be found at Eloise. Late last year, we followed up a single historic intercept, 400 metres down dip. We drilled a hole and intersected 27.6 metres, grading 4.14% copper and 1.9 grams per tonne gold. Further drilling has delivered significant widths and grades, as shown on this slide and our quarterly reports. This culminated in the recent maiden resource estimate for the Lens 6 deposit of 580,000 tonnes, grading 3.4% copper and 0.9 grams per tonne gold. Lens 6 is located only 150 metres away from current development. It remains open up and down dip and along strike. The acquisition of D Metallica not only delivered Jericho, but 2,000 square kilometres of prospective tenements. High quality geophysics and initial wide space drilling has been completed by former JV partners, Oz Minerals on the western side and Sandfire on the eastern side. That work is immediately useful in our search for satellite deposits. Even a relatively small deposit like Sandy Creek, 40 kilometres west of Eloise, is important from a hub and spoke perspective. We are currently planning a drilling program for Jericho, and once that is finished, we'll move the rig to some of these regional prospects. We have a cornerstone asset located in one of the most significant copper producing regions in the world, a region where many more opportunities for growth exist. We continue to look into the region for projects that will grow and improve our asset portfolio. Our growth strategy is a growth strategy that was honed and refined over 10 years at Evolution Mining. We are now applying that strategy with the same energy and discipline in the copper space. We are targeting late stage Australian copper and gold projects. Any acquisition we make must be value accretive, logical, and opportunistic. To wrap up, we're a highly credentialed, heavily invested team. We are transforming Eloise into a reliable, long-life copper mine of meaningful size. Our aim is to build a portfolio of copper and gold mines in Australia through exploration, development, and acquisition, and thereby add considerable value for shareholders. Thank you for your time.
Thank you very much, Aaron. Well done. That was very impressive timing there too. Tim, I'm running a little bit late in this room, so keep your eyes on those programs. If there's something you wanted to see in auditorium 2, make sure you do go between the two of them. So if you've just popped in for our panel, That'll be kicking off in about 15 minutes. In the meantime, though, I've got another great investment opportunity for you. So our last presentation prior to panel 2 is all about steel. It's what's holding up the roof. It's all around us. It's inseparable from the alloys that spice it and bestow it with special properties. And it takes more than 150 times the power of a typical EV battery pack to smelt a single tonne of these ferroalloys. Someone has got to produce yesterday's metals today. This is Adrian Lowe. Adrian, welcome to you. Adrian is the MD of OM's Singapore office, and he's here to tell us all more about smelting in Sarawak today. Would you please make him welcome?
Thank you. Thanks for the great introduction. I think the lighting in the room is not conducive to a late lunch, but I hope being the last presentation before the panel, I hope to get your attention. Look, I think, my presentation will be quite different from what you've heard. We're not a battery metals company, neither are we an exploration company. We have been listed on the ASX for over 25 years now, and for people in manganese, 25 is a special number. So I'm just here to provide an update on OMH because, despite being on the ASX for a long time, I think we dropped off a lot of people's radar about 2016 when we were busy building this plant. This is our smelter facility in Sarawak. And we have, in a sense, really completed the transition from being a mining company into a processing company. So from, upstream miner, moving to downstream. And so that's what I'm here to share with you today. Okay, so being in the manganese and silicon space for over 25 years, really what we're doing in the latest iteration of OM Holdings is to marry the knowledge and the know-how that we have with the asset that we have in Sarawak. And the asset is not the plant. The asset actually is a decade-long power contract with prices fully locked in until 2033. And so the key question is, how do you deliver value from that power contract while playing into what we know best, right? Metals, manganese, silicon, and today, how do we power the renewables transition? So that's what OM Holdings is all about today. So if you don't take away anything from this presentation, just remember one thing, 10 years, fixed price, hydropower, sustainable, and 350 megawatts of that power. We have been, since a year and a half ago, we have been dual listed on Bursa Malaysia. So I think we're fairly unique in this regard, having the dubious honor of being the only company that's dual listed on the ASX and Bursa Malaysia. And I believe we are the only ferroalloy smelter that's listed on the ASX and Bursa. So I'll talk more about our cost figures. We have been in operations for close to 10 years now at Sarawak, so we have a fairly good track record there. And so just a short slide on key operations. I'm not going to talk through everything you see on the screen, but right there, right on top, you see Sarawak, Malaysia, and that's sort of the crown jewel of OM Holdings today. We do have a smaller facility in China that was built over 15 years ago. It's shut now because of everything that China is doing to discourage power-intensive industrial processing. And that is actually a boon for what we're doing in Sarawak. In the bottom left corner, you see exploration and mining. So in Australia, we have a couple of junior exploration tie-ups. I'm not going to talk about that. If you're interested to know what we're doing in Australia, feel free to come by our booth. It's booth number 8. But we do have a meaningful chunk of the Chippy Boa mine. That's 13% of one of the largest mines, manganese ore mines in South Africa. So for people who are familiar with manganese mining, if you know Jupiter Mines, GMS on the ASX, that's exactly the same asset that they're holding. And I think they have about 50% of that mine. So, I think in introduction, we sort of try to play with metals of today versus metals of tomorrow, because, looking at the theme of the conference, future-facing commodities, what we're doing is not exactly revolutionary or new. And on the left, you see metals of today, ferroalloys. So this is a raw material that goes directly into steel making. So in a sense, think of how restaurants use salt, right? All steelmakers have to use ferroalloys at an intensity of about 1 to 2%. So every ton of crude steel, it's about 10 to 20 kilos of ferroalloys, and that ranges all the way from basic rebars to steels that are used in transformers, foundry products, and so on and so forth. And so that's a huge base at a very sort of low intensity. And we have the benefit of being a super low cost producer based in Sarawak, supplying that to the world. Okay, so this is today. This is nothing new. This is very conventional. The only difference is we are sitting at a very, very low point in the cost curve, and we have hydropower credentials that today are not being valued. Okay, that's today. Metals of tomorrow, this year, something that we're embarking on is the conversion of 2 furnaces that used to produce ferrosilicon, so that's silicon used for steelmaking applications, and upgrading that facility to becoming a smelter that can produce silicon metal. And that is a 99% pure product. And as its name suggests, silicon metal, it's sort of the key functional ingredient for solar panels, for semiconductors. And I think this is what will power the renewables transition. And the world is incredibly dependent today on a single source for silicon metal, and that's China. So I'll talk more about that in a second. But besides applications in solar panels and so on, it is also used in the production of silicone. So silicone rubbers, as you can see on screen, as well as an alloying metal for aluminum. So smelting is an incredibly power-intensive operation, and this picture's sort of meant to give you a sense of how much power it takes. So if you saw the Polestar at the booths, I noted that that battery is 78 kilowatt hours fully charged, and so a ton of ferrosilicon, and that's about sort of super sag big bag amount of ferrosilicon contains 117 times that power. So if you had that car, you charged it once every 3 days, it would take a year, right, to sort of collect enough power to smelt a single ton of ferrosilicon. And we are producing something like 120,000 tons of ferrosilicon per annum, and producing 240,000 tons of manganese alloys per annum. So that is the sense of scale of our operations in Sarawak. And I think with all the growth plans that I'll share in a second, will place us within the top 5 smelters in the world. And so Malaysia as a base for smelting silicon and manganese is a fairly new development. So the 3 plants there, and we are one of the 3, we're the largest of the 3. And between 2014 and 2018, collectively, we commissioned about 1 million tons of capacity. And so you can see just the sort of light orange bit right on top, that supply sort of come in. And this is, the chart shows the top 5 exporters of silicon and manganese alloys. Obviously, there are smaller producers that have been sort of bumped out with the emergence of Malaysia. And so this is really a sort of paradigm shift in this very, very niche steelmaking raw material. And what's interesting about the chart, besides the fact that Malaysia has sort of grown and kind of come out of nowhere, is that the other 4 countries, Russia, China, Ukraine, India, these are the dominant suppliers of ferroalloys for the world. For every single ton of steel out there you see that's it's consumed in daily lives, ferroalloys are coming from these 4 countries. So besides the obvious sort of geopolitical risks and geopolitical concerns, they are also incredibly coal-based. Their power system, their power grids are incredibly coal-based, whereas in Malaysia, we are predominantly a hydropower-based smelting operation. So on the right, these are 2 cost curves that were done post-COVID, so done in 2022. Scales have been removed because input costs have moved, but that gives you a sense of where we stand in the global scale of things. And these are all sort of pegged to CIF Japan basis, in order to give you a sense of what costs look like, not to us out of our factory gates, but to our end users. So today, I would say 80% of our ferroalloys is supplied to the Japanese, the Koreans, Taiwanese. These are the major steelmaking countries in the region, and Southeast Asia. So when we started the plan, started the project, maybe 10 years ago, we weren't really looking at Southeast Asia. I think we signed offtakes at that point in time with the Europeans, with the Japanese. We have 2 Japanese offtakers. They're still around. They're still good partners. But Southeast Asia, the emergence of steelmaking in Southeast Asia and the speed at which it has emerged caught us by surprise. But it's not really surprising when you think about it, because as a region, I think we in Southeast Asia have a long sort of runway to go. When you look at steel consumption intensity in Southeast Asia versus East Asia, that is, just to close that gap will require sort of double-digit growths for many, many years, right? So when you think about steelmaking regions that are in the size of 100 million tons or so, Southeast Asia, India would probably be the last 2 frontiers. And so where we are located in Sarawak, is a great advantage for us. So that's one side of the puzzle. The other side of the puzzle is, I think, in the last 10 years, what I was saying earlier about our plant in China, being sort of slowly pushed out by government policy, this offshoring, deliberate offshoring, deliberate clamping down on steelmaking in China has pushed a lot of investments into Southeast Asia. So when you look at the Morowali Industrial Park in Indonesia, the nickel projects, obviously part of the story, but we see this broader trend of steelmaking capacity being offshored from China into Southeast Asia. And just right next to our plant at the Samalaju Industrial Park, there's a 10 million ton capacity project that is supposed to come online within the next 2 years. So we see this as a continuing trend, and this plays towards our strengths of being in Sarawak. So I'm just going to speed up and talk about silicon metal. So, I think I mentioned earlier that silicon metal is critical for the renewables transition. And, just on screen, this really a long list of headlines if you Google for this stuff, but basically it has become incredibly sensitive. And I think elephant in the room is China's dominance in supplying silicon metal, and the share of silicon metal that's produced in Xinjiang in China is the lion's share. So I think I'm not going to belabor the point, but a lot of the potential offtake partners that we're talking to for silicon metal are looking at non-Chinese alternatives. So 3.3 gigawatts, this is the reason why we're in Sarawak. This is a picture of the Bakun Dam, and the entire Samalaju Industrial Park, of which we are part of, was designed to take power from the 2 hydropower projects. It's just a picture of our plant. So we fully commissioned all furnaces in June 2018, and we have been running at close to full capacity for about 5 years now. And so this is sort of roadmap of sorts. This year we will be running at about 75% capacity for a couple of reasons, post-COVID and after the highs of the last 2 years. I think with the sort of demand slump coming in, as well as the shortage of skilled labor, has meant that we had to plan and scale down production for this year, but we look forward to returning to full capacity in 2024. In future, we will be doubling down in a sense in conventional ferroalloy production. So that's the first 2 rows, and we'll be increasing manganese alloy smelting. That's the last. That's this one. That's this one here, to be launched in 2 years to expand and build capacity to just over 500,000 tons. And we are commissioning metallic silicon furnaces this year as we speak. I'm going to skip the ESG slide, but essentially our scope 2 emissions are significantly lower than competition. And so not exactly a new business, generated over 200 million in cash in the last 2 years. and I think I'm going to be chased off the stage soon. But we launched a dividend policy for the first time in March last year. So a lot of information on the screen. Feel free to come by the booth, but essentially there's a lot of upside from smelting, something that everyone needs to use, everyone is producing, but someone has to find a green way of doing it today. Thank you.
Thanks, Adrian. Give us your hand. Turn around, turn around. Give us your hand. Come back. I haven't chased you that far away. Prepare to shake your hand. You and I've got 2 seconds here. There's some men behind us who are going to race up and they're going to put some chairs up because we've got our second panel of the day. I am a bit scary sometimes. If this was Australia, Adrian, you're correct. I would have put my size 8 somewhere and you would have jumped off the stage very, very quickly. Just if you've got any of our presenters in the audience, one of the things that I do as a side hustle, which besides investment journalism, etc., and emceeing, is I help people with presentations as well to keep them to time so that we get all that great information through, because I hate it when you have to rush at the end because I know you've got so much great stuff to share with us as investors. Right, so a lot of you in the room for the panel discussion. I'd like to invite Susanta Mazumdar up to the stage. Susanta, of course, is from Tribeca and she is the portfolio manager for their investment partners. Susanta, where are you? Did I just say she? Oh, good grief. Sorry. It's one of those moments in time. How are you, Susanta? Come on up here, sir. Welcome, sir. I'm going to hand you over my microphone and get you to introduce everyone that's coming up on the stage for this panel. I'm also going to give you the task of sending everyone off to afternoon tea, which is going to be very short, okay?
Thank you. Thank you. Welcome to all. Good afternoon, ladies and gentlemen. We'll wait for the other speakers. Okay. We have Dr. Roger Knights from Energies, and we have Brett Woods from Santos. We have Nick Pollack from K2Fly, and we have Cameron Sharp from Caterpillar. Oh, you are here.
Hi, it's Brett. Roger.
Thank you very much. Good afternoon, ladies and gentlemen. We are going to talk about energy transition. It's a pretty complex topic to start with. It's probably the most challenging human endeavor we have done since the discovery of hydrocarbon, which is around 150 years back. Therefore, we believe that the journey of decarbonization is probably more important than the destination, partly because as the technology evolves and the understanding of biosphere improves, our target will keep changing. More importantly, if we look at last 150 years of GDP growth and human lifestyle, they're intrinsically linked with fossil fuels. So if we think about we'll decarbonize the entire world in next 30 years, it's quite difficult, quite challenging in a realistic way. And that is why the journey of decarbonization is more important rather than just the destination. And some of the most fundamental industries like fertilizer, like cement, like petrochem, steel, these are yet to be decarbonized. They're still primarily fossil fuel dependent, in addition to the baseload power and as well as the transportation like marine and aviation. And therefore, I think we need all kind of supply measures and as well as demand measures to reach that decarbonization. This includes renewable, this includes maybe carbon capture, this includes maybe hydrogen. We need all kind of technology to reach to that goal. And in that context, we have got 4 very distinguished members. Ms. Jane Tan of Sembcorp couldn't come. She had to travel urgently outside Singapore. So she is not here. She has sent apologies to all of you. I will introduce our speakers. I will start with Dr. Roger Knights, Energies. Energies Australia is a visionary leader and manufacturer of hydrogen fuel cell products over a decade. It produces products from portable 10-kilo gensets to all the way multi-utility scale hydrogen powerhouse. He has 30 years of executive leadership experience, and throughout his career, he has developed growth strategy and oversees operational performance. Next to Dr. Knight, we have Mr. Brett Woods of Santos. Santos really doesn't need any introduction. It's one of the largest upstream company with very large LNG exposure in Australia. Mr. Brett Woods had over 25 years experience in oil and gas industry, and he is president of Santos Energy Solutions and driving energies, Santos midstream gas processing, as well as clean fuel decarbonization and carbon credit. The third in the cell is Mr. Nick Pollack. It's a very interesting story. He's an ESG software company and does the kind of auditing and ESG rating of the mining industry. Mr. Pollack has 25 years of experience in enterprise software business and more than 20 years in global APEC and regional leadership thing. He has spent 17 years in resource industry, 10 years in resource governance, and 5 years in sustainability. On the fourth, we have got Mr. Cameron Sharp from Caterpillar. Caterpillar doesn't need any introduction, but he's in charge of Caterpillar electric power. And he has very strong technical background with mechanical and electrical field. He has in-depth knowledge in power generation, solar power, and energy storage technology, as well as decarbonization mining industry. So with this background, probably I will start with my first question to Dr. Knight. Yeah. I think the key thing is that what are the different ways we are looking at decarbonization, and in that role, what is the role of hydrogen can play along with other renewable and other storage in decarbonizing mining industry?
Okay, thank you. And yeah, thank you for having me here today. I think hydrogen is one piece of the puzzle. What we've seen from a lot of mines and a lot of large industrial sites, that solar, wind, and battery in particular, which is regarded as sort of low-hanging fruit, because I think there's a lot of really good capability around in terms of being able to deploy that to get some very good return for reducing, particularly your spinning generators, which are your emitting generators. Hydrogen sort of builds from there. And so one of the challenges, opportunities is how to make hydrogen work well as part of that mix. And so those first three things, it's interesting, Sembcorp, not here today, but I had a look at their website, and they offer hydrogen, they offer battery as a storage, they offer wind, they offer solar, and then they offer carbon credits. And so they're missing the next piece, which is, well, how else do you get beyond that sort of maybe 30 or 40% that you might be able to get out of the lower hanging fruit of those things? Hydrogen potentially plays that role. There's always discussion around cost. But if you're looking at the blended cost of a mine site, for instance, where you're looking at, say, let's pick a number, 25 cents per kilowatt hour, that has some very low cost, solar and stuff, because that is clearly, cheap. And then you have some, you're trying to cover your whole mine for the operating for the year. And if you want to go to 100% renewables, there's some expensive parts of that to achieve that outcome. And so hydrogen definitely offers that opportunity. Products are available. You said before, we do kilowatt, we do megawatt. It's been deployed globally. There's megawatt scale electrolysis for generation of hydrogen. So it's all there. I think one of the speakers from a previous panel was talking about one of the capability challenges of rolling out lithium mines. So talking 6 to 8 a year. That's a challenging thing to do if you don't have enough people that actually know how to execute that. And I think hydrogen's a bit similar. It's early in its days, and there's maybe some limited understanding about how to apply it well. And so I think that's one of the challenges, to make sure that it plays a very commercial, reliable role within that sort of broader mix to take you all the way towards 100% renewable at a site.
Thank you. Thank you, Dr. Raj. Mr. Brett, I think upstream companies are always there for a wrong reason in the decarbonization agenda. but the upstream companies themselves are looking for a clean fuel, and you have been quite a pioneer within Australia on blue hydrogen, carbon capture. Could you talk about your decarbonization journey?
Yeah, I think the point was just made spot on. I think we're all coming from a world of ubiquitous energy solution through hydrocarbons. And now we were moving into a world where, you know, technology is moving so fast. Everyone's trying different things, whether it be wind, solar, batteries, hydrothermal, geothermal, nuclear. Every terrain will have a different benefit. Australia certainly has the benefit of great wind and sun. So, you know, a lot of people are playing heavily in that space. And certainly for Santos, we're kind of looking at several key things. Firstly, decarbonise ourselves through things like carbon capture and storage, electrification across all our operations, including our plants, long duration battery storage, where, you know, lithium ions not really going to solve that, you know, thermal type solutions, as well as decarbonising others. So in Western Australia, for instance, we're working with some of the largest miners about reinventing the way they get their power and capturing all the emissions from that. And, you know, then moving into hydrogen, you know, we've probably spent the last 4 years studying the hydrogen supply chain really closely. And I think that kind of really started off with how do we convert, you know, it's quite simple to convert gas to hydrogen. It releases a lot of CO2, so we can capture that CO2 and sequester it in the ground through carbon capture and storage. And then some challenges occurred through global activism. The world is short of energy at the moment. Through the situation in Ukraine, Europe is certainly very short, as well as Asia, because energy is being diverted. So what was probably going to start in terms of hydrogen as low-cost steam reformation from gas to hydrogen to start the supply chain of cheap hydrogen has probably hit a bit of a bump in the road. And the challenge is that hydrogen is probably not there. You know, it's very hard for me to divert gas to a short East Australian market or a short Asian market to convert into hydrogen to a market that's not there. So companies like ours are probably starting to think of jumping past a little bit of blue hydrogen and going straight to green. But then the challenge is cost, where green hydrogen's like 4 to 5 times more expensive than grey and then blue hydrogen. So you've seen in Australia, for instance, 15 to 20% increase in energy prices has had cataclysmic effect on inflation, and, you know, Australia's kind of coming to a halt because of inflation. And, you know, imagine what it does when you turn energy prices up to 3 to 4 times. So I think companies like ours, and I think the intent of much of the talks over the last few days is really about how do you deliver low-cost, sustainable energy through the transition. And that's why we're working very closely with our partners to try and decouple the end effect. You know, how do we decarbonise? How do we electrify? And ultimately, how do we generate on that backbone clean fuels outcomes that can be consistently lower emissions for the future?
Thank you. Mr. Nick, I think it will be very interesting to talk about your bit of your company, and in the current context of the ESG trend and the public reporting, there has been a lot of issues there. So how do you take it as a kind of neutral role and to kind of play that what investors are getting and reading on the ESG side is the correct one?
Yeah, sure. So K2Fly provides software to our clients. And we focus on resource governance, and resource governance is there for our customers to help capture the information in and around their operations, both mineral and land, that contribute to their ESG story. Importantly, as we see the rapid evolution of ESG requirements and the plethora of requirements coming in from all sorts of stakeholders, how those organisations not just get their licence to operate in the first place. And we see a lot of presentations today and tomorrow about new starters and getting licence to operate, getting permits, things like that. How do you maintain it, and how do you talk to the industry or talk to the stakeholders more broadly about your right for that? And we've seen many examples of organisations rapidly destroy that trust with the community by poor systematisation of those sorts of things. So it's not a one-off type of thing at the beginning. You've got to systematise it, and we call it the golden thread between the resource and into the ESG, baking that practice in, just like we've done with health and safety. But we provide the systems that support the standards, whether they be regulatory standards like the Mineral Resource Reporting Standards, JORC, SAMREC, etc., and they're increasingly talking more and more about ESG, building those in. There's all sorts of things like that. And then capture that information, and then so we're always building to the standard, creating the standard, what the expectations are, and then the disclosure, and making sure those disclosures are very, very well governed, and you can stand by them.
Thank you, Nick. Thank you. Appreciate. Cameron, I think one of the most difficult things, everybody wants electrification and they want to make everything as much as electrified, but mining trucks, bulldozer, dump, these are the most difficult ones to do that. And that's probably the most challenging stuff. How do you see what kind of role Caterpillar is playing in there?
Yeah, certainly. Well, I mean, my career spanned 25 years now. I started off working on large engines, and it's been interesting to see the transition that's taking place over that period of time. Renewable energy is becoming very big. Hybrid power systems, decarbonization of mining fleet. It's very interesting to work with a company like Caterpillar, who are seeing our technology kind of flipped on its head. So we've been in electric power since 1939. We produced the first generator set. We've been doing hybrid power systems since 2008 with the US military. So it's really interesting to be seeing this, electrification of large mining fleets and what that encompasses. I'm not so involved with the mobile fleet itself. I'm more involved with the electrical infrastructure and charging aspects. But it's huge, with my previous employer, I saw some of the first hybrid systems that were deployed in Australia, incorporating renewables, gensets, batteries, etc., into the mining industry. And with Caterpillar, I'm in a fortunate position where I'm seeing some of the first deployments of some battery electric fleets. So, it's fantastic times, and it's exciting. It's exciting times to be part of the mining industry and part of the supply infrastructure into said mining industry.
Thank you very much. Probably, I will start maybe with you, Cameron, is that what else mining industry can do to decarbonize itself in addition to, let's say, electrification of machinery? What else they can do?
Well, I mean, we're seeing a lot of electric power systems which are now incorporating high percentage of renewables. There's some in Australia that are looking at 80 to 85% renewables. So the diesel and gas generation are purely there for firming infrastructure of said power. Obviously, renewables has intermittency based on wind and solar availability. But it's really interesting to see what's going on, across the full mining industry, from camp power to power for processing, right through to the mobile fleet. So I wouldn't say there's an area that's being not looked at. Just some of them are higher priority than others. You've got to look at the most polluting, or the most, where the most emissions come from.
Thank you. Mr. Wood, I think a question will be like, we have heard a lot of energy security versus energy transition. Are they mutually exclusive, or we can achieve both the angle, particularly from, let's say, Australian angle? Can we achieve the both without sacrificing other agenda?
Yeah, that's a great question. So, energy security is kind of a bit of a reimagined concept in Australia. Europe certainly knows about it. Japan knows about it. Japan take 10% of their LNG out of Sakhalin, which is in Russia. So they're questioning whether they should be still taking that gas, for instance. So they're thinking, where do they get it next? So, the whole world needs to decarbonize, and that's clear, and that's facing everyone. But they shouldn't be mutually exclusive. For instance, we're working with a Korean partner who, with an intention to take LNG from Australia, turn that into hydrogen in Korea to establish their hydrogen supply chain to drive their emissions down in that country, and then to export their CO2 to stores like what we're working at within Australia, effectively a closed loop supply chain system. So I think that for me, the key message is we shouldn't be demonizing different parts of the sector. Alan Finkel, who some of the Aussies in the room may know as Australia's ex-leading scientist, describes, gas generation plus CCS has a lower carbon footprint than green hydrogen. So you can sit there and you have to understand what is your problem and how to solve it. And these systems should be able to work together. The point about gas firming is critical. You have to firm renewables. And if you can solve through decarbonisation, through things like CCS or other methodologies, and you can effectively eradicate emissions, then all those systems make perfect sense. Hydrogen, for instance, I think people don't realise that, we can put hydrogen in the existing pipelines and transport that around Australia, but it's 3 to 4 times less energy dense than the standard fuels that we use. So you go and put 10% hydrogen in your pipeline from Central Australia to, say, Queensland, you only effectively get a 3% benefit of emissions reduction because of the energy density variation between hydrogen and standard hydrocarbons. So, ironically, the best way to transport hydrogen is probably not as ammonia, as most people would kind of imply, as actually as methane, if you can solve the carbon. When I was a boy, at school, we used to learn about things like acid rain, and that was going to end the world. And technology solved that, Black Forest was going to end, monuments around Europe were going to vanish, but we removed sulfur dioxide and nitrogen dioxide out of the atmosphere. So I think, alongside all the technologies and the mining solutions that are being worked at the moment, we still have all the technologies about fixing, eradicating, because countries like Japan physically can't rebuild all their infrastructure. So, if I can synthesize gas out of sunlight, out of water, and out of direct air capture of carbon from the atmosphere, which is scope 1, 2, and 3, neutral or negative. And that is probably going to be a solution for many of the Asian countries that don't necessarily have that ubiquitous land mass that enable large-scale renewables.
Thank you. Dr. Knight, I think another issue with hydrogen, as in, again, Mr. Brett would talk about it, transportation and the scalability means, we talk about gigawatt hydrogen plant, and we have still largest plant is probably a couple of megawatts. So how do you solve this scalability issue and probably, transportation issue, if you have any insight on that? Thank you.
Thank you. Just a quick one to add to that. We're also seeing hydrogen as to be carried around as methanol. So in particular, the marine space is very, very interested in methanol as a way. So that brings a different challenge because you need methanol reformation, be able to produce the hydrogen to then use it, which does create CO2. So if you've got green methanol, it's a neutral source, or there's a way in which you can capture that as well. So that's one way to overcome. Methanol is easy to carry, it's easy to store, it's low cost for storage as well. So I think a lot, as you said, there's a lot of different things being looked at, which will provide substantially lower economic solutions for people rather than sometimes some very costly storage options. Pricing and scaling, it's an interesting one. So put it in context, I think the biggest electrolyzer, or PEM electrolyzer, I should say, there are alkaline ones out there. The biggest PEM is about a 20 megawatt system that's running. So on the generation side, a lot of the major suppliers have actually done a very good job of building blocks. So they can scale them quite easily because they're just multiples of that. Now, there's an economies issue. But for the moment, there is really good scalability, and a number of the major international suppliers have done a really good job of building blocks that they can just scale out. So that'll come. So if people wish to put in 50, 100 megawatts and above, then that can be managed through those scalable blocks. On the generation side, so the power generation side of the fuel cell, it's a similar process. In the small systems, we've got really great building blocks. If anyone's interested, out in the foyer area, you can actually see there's a fuel cell rack out there. Just come and have a look. And then they are used as racks to build large building blocks. So you can buy one, you can buy 100. And one of the things I think that's happened as the maturity has come into our space, we've been lucky to tap into the solar sector and the battery sector and so there's a lot of power electrics which have gone way down a cost curve. They're very reliable, they're very available, and they are basic building blocks for big systems for the hydrogen space as well. So I think we've benefited from a lot of extra maturity in other parts of the market, and I think our market sector as well is mature to a point now where we can offer up good, reliable building blocks that are economic. Fuel cells are very different to diesels. Diesels are much lower cost to upfront, but they cost a lot to run. They cost a lot to service. Fuel cells have a higher capital cost up front, but the through life cost over a 10-year or even less than 10 years, it's lower to run because they require very little maintenance. And that's a big difference. And I think that's one of the things that the industry adopting has got to get past as well. They've got to have the confidence of the through life cost of a product rather than just the capital cost.
Absolutely. So essentially you are saying the modularity of the electrolyzer fuel cell can actually help hydrogen industry to scale up.
Yeah, absolutely. So I think a lot, as I said, there's been a lot of, I mean, fuel cells, people talk about fuel cells. There are tens of thousands of fuel cells running around the US in forklifts. You know, they've been used in the Navy in submarines for years. So they're a reliable piece of tech. What we're seeing now is them just scale up into larger packages. And I think there's a lot of very good, they're used in trains all around Europe as well. So there's a lot of very good, reliable information now about how they perform. And so the industry, as it's matured, has taken that information and is putting it into good packages now, which allow that scalability.
Thank you. Thank you. Question to Nick. I think since morning, we heard quite a bit of fascinating story of different mining companies, projects, and particularly which are very critical for the battery materials projects. From your side, again, you were looking for a kind of like a third-party observer. You were involved, but you were looking from a neutral perspective. What do you think are the key challenges for these projects to come, and what I think companies should do the right thing to do?
Yeah, so I think I touched on that before in terms of being ready with the right systems in place. But, in terms of the sorts of standards that these organisations should be looking for, it's like drinking from the fire hydrant. That's the wonderful things about standards, and particularly as it pertains to ESG recently, the industry is awash with them, all industries, not just mining. And carbon's a great example. I think that's probably one of, in some ways, some of the more better governed and well understood ways of reporting. If I was to talk about mining companies specifically, there's additional overhead for mining companies because there's mining specific requirements. I'll talk about two of those, and some of those have been brought about by the industry bringing them upon themselves. And the most recent and headline worthy, I suppose, was the Brumadinho disaster in Brazil. Tragically, 275 people died. Communities were wiped out, and that was the failings of the tailings dams. Tailings dams have been failing for years and years and years. So the investment community and others like the ICMM got together and said that's not good enough anymore. We need to have better management of these facilities, zero fatality goal, working with communities to make sure they're safe, and then ultimately disclosing what you're doing about that. There's 17 to 30,000 of these dams in the world that need to be managed and maintained and talked about. So, that's a really important thing, not so much for startups because they don't have the legacy, but certainly for the legacy operators or the people that have been operating for a while. More traditionally, you have the mineral disclosure codes, which go across the different stock exchanges. And that's something that we're very involved in globally. So we work with, companies all over the world reporting on multiple listings and then multiple different codes that go with that. And all of those codes in a sort of a cycle, whether that be JORC or SAMREC or SK1300, are constantly revolving and looking more and more at how they integrate ESG factors into your disclosure of your mineral resource and reserve, which is obviously the foundation of a resource company's economics. And it's fascinating because traditionally, if you look at the tenets of those codes, a big part of that is competence. And the competence of the geologist to sign off on that mineral resource and reserve. And you've got to ask yourself, what's the geologist's competence in actually building in the ESG factors? And I'm not talking about boilerplate answers, I'm talking about a true understanding of what the value implications are. And that's not a criticism of geologists, by the way. It's just the nature of change and these codes changing. So it's a massive challenge for the industry, and it's one that we hear about and all the sorts of standards coming, but that one's not talked about very much, and it's constantly evolving. And I think it's something that I'd urge people to be aware of and make sure that you're paying attention to.
Thank you. Can I have one question or maybe? Okay. No. Thank you very much. Thank you for coming and spending time and talking about some of these things. Thank you.
Thank you.
Apologies, team. It was a really good conversation. I know we'd like to go longer. Wait, our cameraman wants all of you up in his stage. Reverse people. We're going to get